Every night it does. We'll have two speakers today. The first speaker is going to be me, Edward, and I am a senior in high school. And our other speaker is
Panakin. I'm Panakin Kale. I'm currently a senior at Mattia Valley. I run cross country, and both me and Edward are interested in going into finance in college and studying business and things like that. And along that way, we've learned a lot of things, such as, especially in saving and investing, that we thought we'd like to share.
And if you have any questions, feel free to write it down in the comments section, and we'll get to answering that later. So
I think we can get started.
Yeah. So today we'll be covering 5 different topics. And our first topic is we're going to cover to understand why financial literacy is important. And that is because a majority of Americans can't understand basic financial literacy questions.
Some other reasons why financial literacy is so important, especially as you get older, is that especially a lot of younger people kind of tend to overspend or might be a little bit more immature with their money. And when later on in life, they have more expenses that are piling on, maybe they want to buy a house, maybe they want to start a family. I think not having that initial investment early on when they were young really can set a person back. And especially having zero financial literacy, I think we've seen the biggest consequences actually here in the US, which is surprising considering how wealthy of a country we are. So for example, credit card debt, you hear about it all the time in the news. It's at its highest levels ever. It keeps getting larger. If I were to ask 40% of the people in this call, let's say we're all adults, 40% of you couldn't give me $400 immediately and be able to afford it. And in a survey done, around 50 to 51% of Americans did not have enough money to be comfortably get by, meaning most Americans were living paycheck to paycheck. Each paycheck pretty much got through all of their expenses, and they didn't have too much money they could save. So having that financial literacy is very important. So next we're going to talk about investing, as I mentioned. So why is investing so important? Well, pretty much the sort of textbook definition of investing is spending money on something with the expectation that it gives you something back. So probably the most common forms of investing are real estate, merchandise, and securities, which we'll get into. Real estate, I think, is the most common form of investing. You hear it all the time. Your parents want to buy a house, or your dad might be talking about the real estate market all the time. But real estate is really one of the best investments you can make because it's a physical house. And its value can go up and down. Merchandise is a little bit more niche. It really does depend. So for example, if you go into comic books, for example, a comic book from maybe 1980, which was worth 20 cents back then, could be worth $100 today if it's kept in pristine, mint condition, or maybe you might have a limited edition piece of clothing or limited edition item that could have value. The main issue is that you often have to own a lot of merchandise in mint condition in order to actually make a substantial amount of money. So it's more for niche, just small amounts of investment that you might want. But securities, at least in both me and Edward's opinion, is one of the best ways you can get a high return on investment and be able to more easily invest your money in. So what exactly is a security? Well, again, textbook definition means any proof of ownership or debt that is assigned a value and may be sold. Now, 90% of you have no idea what that means, but pretty much a security is just a proof that you own something. So for example, you might buy a stock in Microsoft, which means that you own part of Microsoft, or you might go and buy a stock in Apple. That means you own a very small amount, but you do own a share in Apple. And owning more than 50% of a security means that you're the majority owner of that security, or in this case, that company. So there are several types of securities. One is stocks. This is the one you hear about all the time. Recently, if you guys have been following the news, you saw how on Reddit they were trying to pump stocks all the time to raise their value. So pretty much stocks are just shares in a publicly traded company. Some areas where they're traded are the New York Stock Exchange, the NASDAQ. If you follow any stock markets in Asia, you might have heard of the market in China, but they're pretty much just small little chunks of companies that you can buy. You usually buy them through a stockbroker like Fidelity or Charles Schwab. Now, some of the advantages of the stocks is that they're really easy to buy, easy to invest, trade, and especially now that everything's moved to more digital trading access. The cons is that it is really high risk. You really do want to do a lot of research before buying into a stock, so you can minimize your risk. Now, the other really important form of security are bonds. Now, these are usually issued by governments. So, for example, the US Treasury bond is a really popular bond that people can buy. You can think of it kind of like an IOU from a government or corporation. You pretty much lend them a small amount of money and they pay you back that money after a certain point through an interest payments. Now, unlike a stock, though, there are zero ownership rights. So you don't own a little chunk of the government. You're just loaning them some money. Edward, I think you're muted. All right.
I think you're supposed to do this slide too.
All right. I could cover you for it. For those of you in the audience, Edward unfortunately got a concussion, so I'm covering for him a bit. Yeah, look at that approving thumbs up. All right. Some other types of securities that we have are notes. These are, you don't really hear about these too much. They're a little bit out of fashion, but they are still issued. Again, this is similar to a bond that they are an IOU from a borrower to a creditor. So they are used sometimes by the US government to give out T notes for infrastructure. So T notes are pretty much just very small loans that they might give to states or cities for infrastructure. But you can actually issue a note. So for example, let's say your aunt wants $5,000 and you want to give her $5,000, but you want to make sure that she pays interest on it. You can issue her a note, which gives her an informal loan. And issuing that note instead of just giving her $5,000 makes sure that she legally can pay you back. Another is a treasury stock. This is similar to a normal stock, except that it has been repurchased by a stock issuing company. The benefit is that it reduces the amount of equity or sort of liabilities that are actually on shareholders. And there are two ways to measure it. It's the cost method and par value method. The cost method is pretty much how much value you actually bought it for, and the par value is, I think the easiest way to say it is how much it goes on the market. Now, the third major type of security are mutual funds and ETFs. Mutual funds, at least in my opinion, other than real estate, is the most stable form of investment that you could get. It's typically bought by, I think, a lot more of the older generation, but that is for good reason. It's very, very low risk because mutual funds are such a huge pool of money where a lot of people put money into it. And then you have professional investors who are buying certain genres of portfolios. So for example, you can buy into tech mutual funds, which is just a lot of traders using your money to invest in different tech companies. You can get into industrial and mutual funds, which might put their money into industrial companies like maybe John Deere. So really there are a lot of them. And because they're managed by professional, they're again, low risk. You do have to pay a commission, usually a lot higher of a commission than a stock. And the other thing is that they cannot be traded as fast. So they can only be traded a day after you issue a sell. And then an ETF is a security that tracks a stock index. So pretty much a stock index is something that measures the performance of the stock. So for example, the Dow Jones Industrial Average measures the top 50 companies in the US. And it's just a great way of seeing how the market is doing in general. An ETF just tracks how that index is doing. And the main thing is that it can be bought or sold like a normal stock. Some pretty important vocabulary to know. First are dividends. So dividends are issued by companies as an incentive for investors. So for example, let's say about $1,000 worth of stock and the stock's issued a 10% dividend. That means that every single business quarter, which is around 3 months, the company would send you 10% of the stock value that you own back. So again, if you own $1,000, they would send you $100 check every business quarter, just as a little reward for actually owning their stock. Another is sales. So I think you hear this a lot, but you'd be surprised how little people actually know what the word sales mean. The sales pretty much just is how much I sell, how much product I sell at how much price each. So for example, I sell 10 phones at $1,000. My total sales is $10,000. Again, it's in business and especially in finance, the math is actually pretty easy to figure out. Now, next is earnings. So earnings is sales minus taxes. So for example, you have 10K in sales, 500 in taxes. Your ultimate earnings is only $9,500. Now, equity, I mentioned this earlier, but equity is pretty much an ownership of assets that have debt to them. And there's two ways of measuring how much an owner's equity is. There's the book value, so how much a company owes on net worth on paper. So let's say you were to look at Apple's book value might be maybe $2 trillion, but then, taking into account how much assets they own and how much liabilities they have. But then there's also market value, which is how much a company is actually worth on the stock market. So again, going back to our example with Apple, they might only have maybe 2 trillion, which is still a lot in assets, but they might be worth maybe $2.5 trillion on the actual stock market.
Okay, so we're going to now talk about the important parts of the stock summary. So if you look at number one, that's going to be the stock ticker symbol. So for Coca-Cola, the stock ticker symbol is KO. And use the stock ticker symbol in order to find a stock easier instead of typing out Coca-Cola stock. You just type out KO and the Coca-Cola stock would pop up instead. So for the number two, it's market cap, and a market cap is calculated by multiplying a company's shares, like they are releasing out to the public, multiplied by its price per share. And it's pretty much just the total value of all the shares that they're releasing out to the public that people bought. And price to earnings ratio, or known as P ratios, for number three. And the P ratio is calculated by the current share price, which would be $51.09 divided by the earnings per share. And for number four, it's going to be the dividend yield. And the dividend yield, as we covered before, is what the company will give out from the current stock price for owning the stock. And for the Coca-Cola, it's going to be 3.29%. And for number five, it's the high and low of the day. So during this day, on March 16th,
time of the year.
March 16th, it's $51.48. That was the high that day, and the low that day was $51.05. And for number six, the 52-week high and low. So that shows the highest value the stock was and the lowest value the stock was in the past exactly 1 year. So for Coca-Cola, it'd be $54.93, and the low would be $36.27.
All right, so now we're going to do a stock ticker activity where you guys try to guess the actual stock tickers for each of these companies. So as you saw with Coca-Cola, it was KO, but oftentimes the stock tickers themselves are very close to what the actual company's name is. So spend a few minutes and see if you can try to guess these tickers without looking them up.
And you can type in chat what you think each one is.
I'm going to take a guess, and I'm thinking it might be so simple that it's completely wrong, but is Best Buy BB?
You're actually pretty close.
Nice.
It is actually BBY. So you were actually very,
Oh,
very close.
excellent. Looks
All right,
like
do we
in the
have any more?
chat, we've got
Oh,
someone asking if Apple is AP. Someone
no,
guessed
it's
Nike is NK.
all right. So Apple is AAPL. Target, Target stock, I believe, is actually TGT. So yeah, so BBY there. Target is TGT, and then try to guess for Nike. Any NKE. Pradian, you got that right, and Preet, you both got that right. It is NKE. So now we're going to actually talk about general banking. So this is a little bit, again, as Danae mentions, general. This doesn't go super deep into banking itself. I think that's more a conversation that is better to have with your parents. But I think this will pretty much give you a good start on understanding what exactly is a bank and what banks do. So first off, a bank is pretty much an establishment that invests funds that's deposited by customers and then gives it back to you when it's required. A bank can also just be a place that stores your funds safely instead of having your funds out in the open. So one thing you often hear about banks is something called interest. So interest is pretty much a charge that's paid by a borrower to a lender based on the percentage of funds. And there's a lot of different types of interest, such as compound interest, simple interest. You might have learned about this in math, or if you haven't, you will. And for example, let's say a bank, let's say we have maybe Chase Bank, they might pay interest to a customer if they keep their funds in a bank, or a customer might pay interest to a bank if the customer chooses to let the bank use their funds to give out loans. So pretty much it's a way for banks to make sure that you stay with their bank. Another thing you're going to often hear about is credit. So, ads like Credit Karma ads used to pop up all the time on TV. Especially I remember when I was younger and I had no idea what they were talking about with credit. So credit is a sort of mathematical way of measuring the trust between a bank or a lender and a customer. And it pretty much gives out whether or not a bank can give out either a loan amount or some sort of security and can guarantee that it will be paid back is usually measured by a score. So pretty much some ways you can, I think a good credit score is usually in the 700s range. A bad one, I think, is usually anything above 600, 500. So if you can get your credit score high, it's very good. Some ways credit scores can be lowered is not paying the bank, is not paying your loan back in time, which is very bad. Not paying off your credit card. So if you decide to take out a credit card and you miss a couple payments, your credit score can go down. And some ways of increasing your credit score is taking loans and paying them off in time and in a quick fashion. And also paying off your credit card early or on time, or making sure that you get a credit card that you don't spend too much on. And actually getting a credit card is one of the best ways you can easily and quickly build credit. Just using one credit card to make general expenses and then just slowly paying it and just making sure you're consistent on payments will give you a good reputation or a good credit score to banks. So if you want to ever take out a loan in the future, maybe you want to start a company or you want to buy a house, that's one way you can do it. So Edward, I think this is you.
So for banking, so what is a bank account? And a bank account is pretty much just an account on which you could put your money inside, or you could take out the money that you put inside. So there's three different types of bank accounts, and the most popular of them two are the savings account, checking account. The savings account is like where you put money that you want, that you don't need like right now at the moment. We can access when you want it later. And the bank uses that money that you put inside and charges interest. And it's usually for long-term savings like college funds. And nice thing about savings accounts is that it usually has higher interest rates because you don't access it at the moment. And the banks can borrow and use it for their own good. And the checking account is the most common type of bank account and allows for easier access to money. And it's used to like pay bills, or you can like write checks to other people. And also you can use it for like at ATMs if you want to like, if you're like a festival or whatever and you want to take some cash quickly out, you can use ATM. And the last one that's not as common is a certificate of deposit or a CD. And it's an account that holds like a fixed number of money for a defined period of time, whether it's like a few months or a few years, and it pays interest rate on that amount. And it's this more niche. Okay, so for this graph, it shows that if you kept on making a compound interest rate of $10,000 from the original $1,000 that you would put in the investment, you would end up with $45,000 after 40 years. So if you do not know what compound interest is, it's the idea that you add money that you make from the interest and you add it onto the original amount of money that you have. And then after you find interest of that and you keep on repeating it. So like, here's an example. So let's start off with the first year. So during the first year, you'd make 10% of your original $1,000 you put in, and that's going to be $100. Now for the second year, you're going to put $100 with the original $1,000 you put in. So that'll be $1,100. Then you'll find 10% of that, which would be $110. Then for the third year, you'll add the $110 onto the $1,100, which will be $1,210. And just keep on doing that over and over until you get the 40th year. And like, but like the only problem with 10% interest rate is that it's not really easy because like, for example, like when you put your money in a bank, they will give you interest, but they won't give you that much interest. It can usually be around less than 1% interest. But one pretty reliable source of getting 10% back is the S&P 500, and that's a mutual fund. It's more of an index fund that Panakin covered earlier before. And over the past 30 years, it has returned around 10%. So if you just put like $1,000 into the S&P 500 and then you just like sit and wait for 40 years, you'll get $45,000 from that, only $1,000. So credit card versus debit card. So a credit card is similar to like a small loan. Means you're borrowing money from a bank to buy goods and pay it back over a period of time. And one of the benefits of a credit card is they can increase your credit score, paying off the money you owe at the end of each month. None at that time, you can lower it by not paying off the money you owe on time. And Panakin covered this earlier, but yeah, your credit score can range from 300 to 850, with 850 being the best that you can get, but usually around 700 to 800 is already a good score. The high credit score will allow banks to lend you more money, and at like a lower interest rate they'll charge you. And it's like really helpful if you want to like take a loan for a house or like buy anything really expensive. But the lower the credit score you have, the less likely the bank will let you lend money from them, and they'll charge you higher interest rate. And so it is important to keep a high credit score. So for most so in order to like do that, a pro tip is just like don't take more money from the bank than you make. So for example, if you make $100,000 a year, or like for example, if you make $50,000 a year, you don't want to take $100,000 out from the bank because you can't even afford that with 1 year's salary. So you gotta watch what you have and watch how much you take out. And like so with a debit card, it's a little different than that credit card because you're taking money directly from your bank account. You're not borrowing money from the bank to pay for whatever you want. And it is better in general if you don't want to keep on paying. If you don't want to pay it like at the end of each month. But the only problem with the debit card is that it won't change your credit score. And this could be seen as a positive or a negative, but the only problem with the low credit score or like no credit score is that you cannot take out loans, or there's a less chance that you take out loans. So here are some resources for investing. So some TV shows that you could watch to learn more about investing are Shark Tank and The Profit. These shows just really good if you want to learn about real life, like finance, and you could learn a lot from them. And websites, if you want to explore more about what we covered today and learn more on your own, you can use Investopedia, and they offer also a stock market game. So you can invest big money into stocks and buy and sell stocks. And you also use Yahoo Finance, and they keep you up to date with current news, and they talk about the top stocks. And newspapers that you can read if you're interested in newspapers are the Wall Street Journal and Barron's, and these are weekly newspapers that that cover all kinds of securities, ranging from the stocks, bonds, to mutual funds, and they also cover the general economy if you want to know more about that. So here it's a little fun slide. So here are like the 7 basic questions to test your financial literacy. And if you want, you could like look over them, just like think about, do you know all this? Do you not know all this? And if you don't know all this, you should try to like do research, try to get yourself to better understand this information. And I'll drop the link in the chat for the website if you want to look more into it.
Oops, I went forward a slide, my bad. So we got a question from, I think, Preet, asking, why does Social Security go away when you retire? Social Security doesn't actually go away when you retire. If anything, that's actually when you get all the money you put into Social Security back through monthly checks. So pretty much Social Security is more, I think the best way you can see is more of like a government sort of pension plan. So when someone retires, for example, they won't be earning any income, and they might not have the necessary savings to be able to live without working. So the government steps in, the government, I think it was President FDR, stepped in, made it Social Security so that elder people or people who aren't working can support themselves. So it doesn't go away. Actually, that's when you start receiving your Social Security checks. Now, if you were here earlier, we were talking a little bit about how Social Security is a bit at risk. That's if you follow the news a lot and you do read a lot about it, you'll kind of understand the perspective where we're coming from. But for the most part, that's what it is. And for most likely the next couple years or decades, your Social Security is probably going to be fine.
Also going off what Panakin said, so like Social Security, you'll be paying like, so when you're, the times you're working, I think until you're 65, you're going to be paying for Social Security. So you give the government like a certain amount of money each year. And then in a way, the government pays you back when you retire. Like when you pass 65, when you retire, they'll be paying you the money that you gave them back.
So I think Nunes, I hope I'm saying this right, Manus, asked, do you know any good ways to invest at a young age? So some good ways you can invest when you're young. If you want to invest before you turn 18, you can actually open an account. I think it's called a co-parental account, where you can buy and sell stocks but your parents are ultimately the owners of the stock until you turn 18, then you inherit that stock. It's a good way of learning how to invest early on. The only main thing is you want to make sure that your parents are okay with wanting you to invest, because usually when you do invest in stocks, you're going to be investing with a larger amount of money. So that's one good way to do it. When you do turn 18, when you're young adulthood, again, just putting money into mutual stocks or mutual funds, sorry, putting money into stocks, making sure that you do your research and that you make smart decisions about it, I think is really the easiest way. So I think one thing that I really like, especially in the internet age now, is that there are tons of ways you can buy stocks. I think the most popular one, and especially among my generation, Edward's generation, is Robinhood. So Robinhood's just an app you can download on your phone. You can make an account. Again, this is when you're 18. You can make an account, buy stocks, ETFs, options, which we didn't get into, but options is pretty much just it's a little bit of betting in a way, but options, stocks, ETFs, you can buy all of that on Robinhood. So definitely it's a good idea to learn the knowledge before you turn 18, and then when you're 18, start investing.
Also, I just dropped in the chat. If you don't want to use real money, the Investopedia, they have a stock market game that you can use to get practice with stocks, and like it's everything like real stocks, but instead of using real money, they just give you fake money to use, and you could compete with other people online. You can set up like a game with your friends. You guys can just compete against each other to see who makes money, and it's just a really fun way to practice investing without using real money and without the risk of losing.
Hey, your friendly neighborhood librarian chiming in real quick. I would also, like, I'm not an expert by any means, but for young people looking to find an easy way to invest, I would recommend the simple step of just starting a savings account that has a good interest rate. And you want to still make sure that you're putting money into the savings account because they tend to have lower interest rates than other options, but it's a good way to start. And as for this third question here, is an IRA a good investment? I think I mentioned earlier before we started that I invested in a Roth IRA, which is a form of savings where you deposit money and you cannot withdraw it until you are of retirement age. So because that money is inaccessible to you, it has a higher interest rate. So you're accumulating more money than you would with a regular savings account. And I chose that for my personal retirement fund because of the example we were talking about Social Security. It's still okay, but based on certain speculations, I didn't think that I would be able to rely on Social Security in my old age. So I wanted to take a step to ensure that I would have some financial, something to fall back on once I retire. So I hope that was helpful.
All right, so we've reached the end of our presentation. I think there's a good time to ask any questions you guys might have. So I think we'll stick around for the next 5 to 6 minutes. If you guys have any questions, we can answer them. If not, if you don't have any questions or you don't want to stick around, we are pretty much done. So I'd really like to thank you guys. Both me and Edward would like to thank you guys and the Aurora Public Library for having us on. And yeah, we appreciate your time.
Also, before you guys leave, we'll be giving everybody that came here a $5 gift card to start on their ways of saving money in the bank. And I'm going to drop a form in the chat if you would like to fill it out, and we could contact you in the upcoming weeks about receiving your gift card.
Very cool. Thank you guys so much for your presentation. I really loved it. I understood some of it. I'm also going to drop a link in the chat. This is a program proposal form that the library has on our website. Personally, I love being able to invite presenters who are in high school, people who have something that they're passionate about, but sometimes it's hard to find a platform to tell people about it. So I like being able to provide a way for young people to present to their community and try to get themselves out there. So if you have any ideas, something that you think is really important, something that you think could improve the lives of people in your community, or just something you think would be fun and cool, feel free to suggest it to us, and somebody from the library will get in touch with you to organize it.
Also, I just want to thank the Royal Library and Mrs. Crumb for providing us this opportunity tonight. And I hope you guys have all your questions answered. And if you guys have any other questions, I think on the form I sent out, you can ask us any more questions if you have anything.
That was pretty cool.
Thank you.
Yeah, thank you guys so much. That was awesome. Thank you for sharing your expertise with us.
No problem. All right. Let's see,
All right.
It looks
Well,
like we don't
I
have
hope.
questions, so
Oh, sorry.
I think we can call this a wrap.
Yeah, have a good evening, everybody. Thank you guys so much for joining us.
Right, you guys have a nice night, Edward. I will see you later.
See you guys. Have a nice night.
Bye.